Welcome to the daily update where I'll go over the action in the market for Thursday, December 12th, and we'll see how things look for Friday, December 13th. Well, on Thursday, we kind of resumed what had been happening earlier in the week in Monday and Tuesday session with the declines. We saw this weakness starting to develop last week that was throwing up some warning signs, but it wasn't working its way through price. In fact, last Friday, we hit an all-time high with the S&P. Well, Monday and Tuesday we saw a down move, so we did see it coming through in price. Then Wednesday we had a nice up day. Well, Thursday we kind of resumed what we had already been doing, and we're still seeing weakness internally and under the surface, but right now it just still looks like a pullback. We haven't really seriously tested the 20 period moving average, and that's what I use to determine positive or negative in the short term. We're still well above that. But we're also dealing with a period of weak seasonality that will go through Friday and Monday. We don't know if the market will stick to that. We just use that as just something to base things on. It's kind of like a guide. And then we follow the charts to say, okay, what's actually happening that way? All right, there's a thing called the SPX Investing Program. Just a few more weeks now. It's still free. You can go check that out. There are additional videos that I post there. If you have any questions, you can send me an email. And one thing that you do have is access to the videos as soon as they are available, where I hold those back on YouTube and Rumble. Also, this video, the daily video, that's really the foundation of the analysis and commentary that I do. We're coming up to the weekend, so I'll be doing the outside videos in this circle, but they're all meant to tie into the daily video. All right, let's go back and talk about what happened and then look at some charts. We had a lower open. Now, the futures didn't really respond all that much to PPI. There was a bit of a downtick there, but we were looking a little more negative to begin with. So there was kind of that overall negative sense coming in to the session. And we ended up going lower. We dropped below S1 at 6,065. Then we found support. It should be at. And then it was able to climb back above S1 to the daily pivot at 6,079. Then we chopped between the daily pivot and S1. Now, this is where things started to shift. And this is why I focus on later in the day what's happening. The open that got dealt with, and we see the gyration around there, and then maybe a little bit of time will pass. Then it's later in the afternoon. That's when the smart money starts coming in and doing what they want to do. Well, they wanted to sell. So we chopped between the daily pivot and S1. Then we started to decline below S1. And then we actually fell below that 60-60 level. And we ended up closing at the intraday low. So it ended up being a down day. We're not really seeing things falling apart. We're just seeing some more short-term weakness at this point. But we watch these things because usually longer-term weakness starts as short-term weakness. And we're just trying to evaluate, okay, as of right now, yeah, we're pulling back. We're not looking all that great, but we haven't actually turned negative. Okay, we were down 0.54% on below average volume. That is encouraging too, to have a down day and volume actually drop off. We are still positive though in the short, intermediate, and long term when you measure it using moving averages. And then we had some more inflation data that came out, and that was seen as an uptick in inflation with PPI. And that just kind of fed into this negative idea that seemed to already be coming into the market for Thursday's session. And then there's all these crazy things going on geopolitically, but the market just, it's like, okay, they're happening, but we're not going to react to those things. All right, some comments. In Europe, the European Central Bank did cut policy rates by 25 basis points, and that was pretty much as expected. So that wasn't a real surprise at all there. And then the PPI, as I mentioned, is showing an uptick in inflation, and I will show you some charts that in as they apply to that. And what we're seeing right now is just recent weakness because of there's this concern about overvaluation. And I go over that in the weekly video and in the intermarket analysis video. We look at the valuation of the S&P 500. And we base it on a 10, 15, 20 point scale. And we've been well above 20 for a long time. That means we're expensive or overvalued at that point. And then we've had a good run lately with the market. So there's been some profit taking that has been coming in as well. People want to lock in those gains. We still have this non-confirmed Hindenburg Omen, and that will last through December 19th. And we just have on an extreme positive basis the stochastics, those move a little bit slower. All the other things have fallen off the list. So we're not really showing any good upward momentum in the short term right now. We're already seeing some momentum on a short-term basis to the downside. We have the Stoke RSI is already getting extreme negative. And that's it, though. And then in the intermediate term, looking extreme positive, we have the Sean Trend Meter, which seems to have been on this list for a couple of weeks now. And then the bullish percent index for the NASDAQ 100. And no change to the scenario if you watched yesterday's video. Once CPI came out on Wednesday, it pretty much has shown the market that, yeah, the Fed's going to come in and cut rates next week, another 25 basis points, because we're still experiencing this soft landing. And that's what the market is anticipating right now. And we've been anticipating that for the last couple of years, actually. We'll just see, is that going to be challenged at some point? Not yet. Okay, the dollar was up and interest rates were up as well. We closed at 4.32% with the 10-year yield where we had been at 4.27%. And interest rates going back up, even though they went up on Wednesday and the market bounced back up, they typically will have a negative impact, at least during this part of the cycle where interest rates going up will drive stock prices down. And that had a bit of an impact on Thursday. We're getting really close with the 10 to the 3 month yield curve. It's at zero right now, and actually we'll show you the chart later. We've been inverted now for over a couple of years, a really long period of time. I think the longest that that's ever happened. Well, we're right at even with each other. Are we going to come back to being uninverted? Or are we going to slip back down and go inverted again? We're the 10 to the 2. It switched back to being uninverted a while back, and it still remains that way. It spent one day right after the election going inverted again and then switched right back then. Sentiment is still neutral. We ticked down. We had been at 52. We're coming in now at 49. And we're still positive with the trend, though. In the ADX, we're right on top of the moving average here. And if we drop below that moving average, that would suggest a weakening trend. Well, we're not really seeing a strengthening trend, but we still default to that because that was the last reading that we had. We're still above 20, so we are trending. And then with the down day, the bias is negative, and I'm still keeping our momentum at mixed. We still, in the bigger picture, we're looking positive. In the short to even a little bit intermediate term, this is where we're seeing some weakness coming into the market. Okay, the economic reports. Probably one of the bigger days, except CPI was really big on Wednesday. Well, a big report that we've been getting every week here that's the market's really been paying attention to are weekly jobless claims. They came in at 242,000, much more than the 220,000 that they had expected and up from the 225,000 that we saw last week. So a lot of people filed for unemployment more than what they thought. And we're also going back up with the continuing claims at 1.886 million. Last week it was at 1.871 million. And I have charts of this to show you. PPI, this was kind of the big one. It came in a little hot with the headline number up 0.4%. They expected it to be up 0.3% as what we saw last time. And then this actually ticked down a little bit here, but they're seeing some under the surface inside the PPI report, some inflation concerns where the core PPI came in up 0.2% as expected and less than the 0.3% that we did see last time. Okay, so here's a chart of the jobless claims where they had been falling off here. And okay, all right, the employment situation, it's holding up for right now. And this is one of the more current readings that we get. Well, the last couple of weeks, we've seen this turn back up. And so we're seeing jobless claims with the moving average start to go back up as well. And we were dropping off with the continuing claims. And now we're starting to go back up again. And the 4 week moving average is also going up there. So to give it a little bit of context, we have the jobless claims in red, which are going up, the continuing claims in blue, which are going up, and then the unemployment rate, which went up as well. Then looking at PPI, this is final year over year. We're continuing to go up with the blue line. That's the total reading, the headline number. And then the core, the inflation part, that the yellow line here, that's also going up. So we're seeing that on a year over year basis after it had been really declining. Now it's starting to come back up again. And some folks are a little bit concerned about that. And then demand on a year over year basis also going up with the blue line when we look at goods, and then the yellow line are services. So that's also potentially inflationary. Intermediate goods on a year over year basis also going up with the processed and unprocessed goods, flattened out a little bit with the yellow line, but it's still going up. Then here's the chart that I look at, and takes a year over year look. That's the top area here where we're going back up with PPI, but the month over month that actually declined from the previous reading. And then core, this is the inflation part where we're kind of leveling out here on a year over year basis, but we're going back up on a month over month basis. All right, then we look at the real investment advice. This looks at earnings. The annual change in earnings is the best indicator. It seems like I show this chart about once a week, and that's really what drives the market. And we see here the S&P 500, which is going up. That's the black line. And then the forward-looking year-over-year change in earnings, leveling out a little bit here, but still blue. And for the most part, it has been going up lately. And so this is still looking positive. And then the consolidated equity positioning, when we're above zero, folks are getting into things, and we're not necessarily extreme. If we get up to this standard deviation of 1, that's when it starts to get too extreme. And then uncertainty and mean reversion. This is gold, where we've been seeing that pulling back lately, and then different geopolitical events that have happened along the way. And then it says it took 15 years for real net worth. That's when you take inflation into account across all income quantiles to recover. So we're seeing finally, took a while, but we're seeing all of these valuations of real net worth actually coming back above zero. And that was after the great financial crisis. Financial conditions. This actually is giving some support to the market. When this is going down, that means that the financial conditions are looser and more money is able to find itself going into the stock market. When this goes up, that's tighter conditions. And quite often that will mean not as much money is flowing into the stock market. Then here's a chart, and you might want to pause this and just look at it because this breaks down the ownership of U.S. debt or bonds, U.S. bonds, not only within the U.S., but internationally as well. And quite often you'll see that, okay, China owns a lot, Japan owns a lot as well. Britain has some here, and then other countries. And then sometimes that can feed into the scenario that we're working through here. It's like, okay, if these countries start to sell the bonds that they have, that's going to push price down and interest rates up. Well, if they buy, that pushes interest rates down, and that could be more advantageous. But this kind of just breaks it down to different areas. And then incredible shrinking stock market. And this is one thing that's kind of changed here. This century has seen a steady move from public to private markets. Public are stocks. These are like, Amazon, Netflix, Google, stocks that you can go out and buy. Those are publicly traded companies versus private companies where they do have stock, but it's not publicly available. You can't go to a stock exchange and buy it. Well, in the year 2000, we saw a real leaning towards publicly owned companies. These were all the dot coms that were going public, making all their money, even though they had zero earnings behind them. Sometimes they didn't even have an office building yet. They just said, we are a dot com, and you could open up at $300, $400, $500 a share, and suddenly you had people being millionaires. Well, a lot of that so-called wealth ended up vanishing. And then we saw the dot-com bust after that, where you saw a lot less in favor of private companies. And some of this could be what's going on in the as far as policy and they're trying to do with things, because private companies, they're more susceptible to having outside influences on them. And there's a lot more reporting that they have to do. There's a lot more accountability, which keeps them a little bit safer. But when you're more private, yeah, you still have accountability and you have shareholders that you have to be responsible to, but you may not get the outside pressure that you would get otherwise. And we're seeing a complete flip-flop now where there's a lot less US public companies where now they're more going private. And you may hear about this from time to time that a company sells on the US stock market and you can buy and sell shares. And then somebody will come in and say, well, I'm going to take the company private. That means they're just going to do away with being a public company by buying up all those public shares and then keep it in closer hands. All right, here, let's go back and talk about what happened. We did have a lower open. We kind of held up. We at the 60-60 level here. We broke down a little bit below S1 and then we came up and it's like, okay, maybe we're just going to see a nice little bounce from here. Well, we stopped right at the daily pivot and this ended up providing overhead resistance and that was as far up as we could get. And then we chopped between the daily pivot and S1. Then later in the day, as I mentioned, this is when we started to see the smart money coming in and really taking things lower, and we ended up trailing off. We never made it down to S2, but we did close at the low for the session, just a little bit above that 60-50 level. And not much of a change right now. In the initial overnight session, we kind of spiked up a little bit, but then we're coming back down here. But we just saw gradual trailing off here with the futures in the initial overnight session and then the pre-market session. And then here's the cash session when everything gyrated and then some weakness going into the close. This is still positive though. And this is one of the reasons why I say right now things look like a pullback. On an intraday chart, we're still seeing the blue line above the red line. And that means that growth is outperforming value. And that's what we want to see because we want growth to do better than value. That's when the indexes really tend to hold up well. And seeing this blue above the red just can give a hint that maybe there's some actual buying going in on this weakness in the growth areas. This is still looking pretty good too. From the end of November with the growth to value ratio for the S&P, not really breaking out to the upside right now, but you can see this overall uptrend that we've been seeing, and that really helps the market to go higher. And we're not really seeing that in danger at this point. Then we were down more with growth versus value with the large caps, down less with the mid caps, and down more with the small caps. So you see all of this is red. And if you're new to this, the middle area, and the reason I don't talk about this, these are the corresponding ETFs. Like this is SPY on top here. And then we have the value part and the growth part on each side. And here's some end of day charts where the small cap growth to value ratio, we're just starting to see a golden cross here with this ratio. That could be positive. Now, we're not really seeing that here in the index. This is the small cap index where we started to spike up, got everybody excited, and then we're just kind of dropping back. And that's the pattern that we've seen now for most of 2024. So you're not seeing it in price, but we are seeing an improvement with growth versus value down here. And that could be positive if that Santa Claus or January effect or whatever rally that they're anticipating, if that ever really does materialize. And we're seeing also the same thing with the mid caps, where mid cap growth to value is doing quite well right now, but the index is not. We spiked up just like the small caps and then ended up dropping back. But we're seeing some strength under the surface. Same thing here. S&P growth to value not falling apart here with this ratio, still in an uptrend, even though we were going through a period of shorter term pullback and weakness. This is still holding up fairly well. And we're also doing okay here. We compare a growth ETF with a value ETF, and we're shooting up out of the rainbow, coming back close to this really high reading that we had last summer, back when the market was really doing strong and the mega caps were outperforming. And we're looking good here with the discretionary, excuse me, versus staples. Yeah, we pulled back in Thursday's session, but we've been doing really well. And this, excuse me, and this really kicked into gear when we had that big down day, August 5th, when the world was coming to an end, only to find out that it wasn't. And then it's been going back up with this ratio ever since that time. Large cap growth, it was down, but we set an all-time high on Wednesday. And then looking at the trend, this is what I'm talking about. The black line is the ADX, and that's the base indicator that we look at. It's pretty much on top of the moving average, but we're still positive because the green line's above the red line. And we're still above 20, so we are trending, but we're not really seeing any conviction with that trend right now. Short term, Also pretty much on top of the moving average with the green line above the red line. Excuse me again here. We did see a drop off in volume to below average, which on a down day could be taken as positive there. We ticked up here, not a real big move with the VIX, both on a closing basis and with the bar chart. We're still really coming down with the VIX overall. But as we've been seeing earlier in the week, when the VIX it goes up, the VIX of the VIX also tends to go up as well. And this is just showing that there's potential volatility being built into the VIX, which is kind of a danger sign. And the momentum of the VIX is now crossing back above and showing that the momentum is up as measured by the MACD. But overall, seasonally, what has typically happened from 1990 to 2023 is the VIX goes down during this season that we're in right now, but it doesn't mean we go straight down. There are bumps along the way. And we're still getting a high reading with the skew index. Now, this is interesting. The last few days, I've been working on the scenario that, okay, when we were going up, we saw the skew index, which is a variation of the VIX. It was also going up as well. And then we had down days on Monday and Tuesday, and we were dropping with the skew index. Okay, that led us to believe that to get this indicator out of this red area, we would have to continue to drop with prices. And that seemed to go in hand with Wednesday's upward move as well. We went back up a little bit because we had an up day. Well, we had a down day on Thursday, and this is going up again here. So we don't want to read too much into, try to interpret this all that much as far as what we think the result is going to be. We use other charts. And right now, yeah, it's showing some weakness, but there's also some underlying strength in the market currently. And we were up with this fear gauge, and we were down just a little bit with this fear gauge. So seeing a little bit of contradiction across these two charts. This was kind of interesting. This was from Isabel Net. This is what are the expectations as far as what do they think is going to happen? Expectations for 6 months going forward that people are going to have an increase in income. Nah, they're really high there, a little bit on the positive side. But looking out 12 years, what are they, 12 years, 12 months? What do they think stock prices are going to do? And because the market's been doing good now, they think it's always going to do good. So you have a lot of folks that are really anticipating that the stock market is going to be higher. And the market usually likes to do the opposite of what people think it will do. So this could be a little bit concerning on this chart, looking out about a year from now. We did get a reading from the American Association of Individual Investors. We dropped off a little bit here, not really showing much of a change from the previous reading, not extreme right now. We really shot up with the daily chart of the equity put call ratio, and we're actually coming back down just a little bit here with the 5-day chart. And here's another look at the 5-day chart. And we're going up here with the 10-day chart. Let me see here. Yeah, we're actually going looks like we're still going up with the 5-day chart. It's really hard to see that. And we're also coming down here, but we saw a big pickup in the volatility risk premium. We're still above this band here. So there's still some, according to this chart, anticipation of fear going out 30 days. Now, looking at the advanced decline line, this is where we were starting to see some warning signs and some weakness coming into the market. Not falling apart because we're still above an advancing moving average, both based on price and volume, but we've been declining. Even with the up day on Wednesday, this still kept going down with both of these. And we're also seeing a trailing off of the new highs. So our 5-day and 10-day moving averages are going down as well, and seeing a little bit of an expansion of the new lows, a little bit more red than green on this chart. And we're seeing this also based on price. We already went negative with the blue line. That's the short-term advanced decline ratio. Now we're dropping below zero with the more intermediate term advanced decline ratio. That's the red line. And this breaks out the shorter term 19-day advanced decline line. We're below zero based on price. We're also below zero based on volume. And this is part of the short-term weakness that I'm talking about here that right now looks like a pullback, but it's definitely showing some weakness. And we're kind of turning more negative here with the accumulation distribution. We're dropping below the moving average now. We were a little bit encouraged after Wednesday when we bounced up off of the moving average. Well, in Thursday's action, we dropped below the moving average where we had been looking more positive after Wednesday. Now we're turning back to more negative since we're below this moving average. And also seeing a decline here with the chicken money flow, going down with the histogram, going down with the red line. This had already been giving us some warning signs. And we're continuing to be negative with the Chaikin oscillator, below zero and declining. So our three smart money indicators are now negative. And seeing a drop off with the vortex, the green line though is still on top, but the red line has been coming down. We actually saw that bounce up a little bit here as the green line's coming down. So it's still positive, but showing some weakness here. And then we look at the advanced decline line for the S&P 500 based on price coming down here, also based on volume, also seeing a decline. And we're seeing both the S&P declining, but we're seeing a little bit more of a sustained downward move here with the NYSE advanced decline line, as the broader market has been showing a little bit more weakness than the S&P 500. And then here's the cumulative advanced decline line for the NYSE, dropping off and actually dropping below the moving average, coming down to about the moving average with the regular NYSE advanced decline line, also down about to the moving average with this other NYSE advanced decline line. And we break it out based on common stock on price, dropping here, and also dropping based on volume. And then we're seeing a little bit more weakness now with our advanced decline line. We're dropping below the moving average with the NYSE common stock, coming right down a little bit below the moving average with the S&P, below the moving average with the mid caps, and coming back down to the moving average with the small caps. And this really never improved. This little uptick, that was Wednesday's up move. So we're below 50 and declining with those stocks in the S&P above their 20-period moving averages. So this is more short-term negative. And we're getting really close to that 50 level with the 50-period moving average study. If we drop below that, that's going to turn the intermediate term part of this chart more negative. We're also declining with the 100-day moving average study and the 200-day moving average study. So not really seeing much other than just, okay, looks like we're pulling back at this point. And it's not all that pleasant because a lot of people are expecting the market to go up. But this is kind of a normal thing that tends to happen right about now, according to seasonality. And we did drop off below the moving average with volume. And we're ticking back down a little bit with the 20-period moving average after we ticked up after Wednesday, flattening out a little bit, but still declining with the 50 and 200-day moving averages. This is the Stochk RSI, where we had been extreme positive just a couple of days ago. Now we're looking extreme negative. This is suggesting more short-term negative momentum. And the Williams percent R, which had been extreme positive, is now dropping back down. It's no longer extreme positive there. Still looking okay here with the CCI 14, even though it is declining, it's above the midpoint, and we're also declining, but above the midpoint with the CCI 20. And the short-term stochastics are no longer extreme. They have been declining. And we're also just barely not extreme in the intermediate term. But the long term, of course, which moves slower, it's below its moving average and declining and still extreme positive. The force index did decline below its midpoint, but still positive. And we're dropping below the blue line and the green line here with the condition of the short-term trend as measured by 20 periods. We want this to get back above these lines to turn more positive. The longer we stay below this, the more the lines will start to roll over and show more vulnerability to the short-term trend. But we're still well above the simple and exponential moving averages based on 20 periods. We'd have to get down to about the 6,011 level to test these. And still right on the border between the +1 and +2 channel with our standard deviations chart. And then intermediate term, we did come down a little bit with the balance of power, but we're still above zero there. We're kind of right underneath the red line and the blue line. We were right in between these two lines after Wednesday. Now we're dropping down a little bit, but we haven't dropped down enough yet to turn these lines down. The longer we stay below these lines, the more these will roll over. And we actually switched back to looking more positive. We spent one day after Monday with the go no go being the lighter blue, that's negative. And then with the up day on Wednesday, that seemed to help things. Well, we dropped down a little bit here. So this is still positive. And the highest high value, it is declining, but still above the midpoint. The TTM squeeze, which looks like kind of a checkerboard here, where it's turning from positive to negative. We turned back to the lighter blue after Wednesday, which is more positive, and now we're turning back to the darker blue after Thursday, which is negative. And declining here, but still above zero with the ease of movement. We saw a real drop off here with the Arun, as we're seeing sellers really starting to come up in, buyers dropping back. But the difference between the two is this oscillator on the bottom, and we're still above zero here, even though it's now declining and getting really close with the S&P McClellan oscillator to getting an extreme negative reading. So we haven't quite dropped below this level yet. And when this is below zero, which it is now, we're going down with the summation index based on price and volume. We're also negative with the NYSE McClellan oscillator below zero and declining. So the summation index here for the NYSE is declining based on price and volume, slowing down a little bit with the Swenlin trading oscillator based on price, but it's still declining, and we're slowing down but still declining with the Swenlin trading oscillator based on volume. This was also giving us some warning signs. As we were still going up a week ago with the S&P, this was starting to go down. And momentum's taking a bit of a hit too, rolling over a bit with the PMO. We've already been turned negative now for a number of days based on price and volume with the PMO. We're still declining with the PMOs that are rising. The buy signals are going down, and we're going back down with the PMOs above zero. The slope oscillator is still looking positive here, but the MACD is starting to cross over negative. So all of our oscillators, the slope is looking positive, and it was looking negative while the S&P was going up. So sometimes these get out of whack with what's really happening. The TSI was actually a little bit more accurate. It saw that last up move with the S&P. It's now turning a little bit more negative here in the short term. And then we're seeing some rolling over here with the MACD, the PMO, and the PPO. We're rolling over a little bit here with the tricks. That's long term. And we're coming back down to the moving average with the other long-term oscillator, the KST. And we're still positive, but drifting down a little bit here with the Copic curve, which is another momentum oscillator. The Sean trend meter still giving us a high reading here, but not an extreme reading. The money flow is above 50, but it is declining, and the ultimate oscillator getting a little bit below 50 here. That's turning slightly negative now and coming down, but still above the moving average with on balance volume. And this is the one that I think is kind of hilarious. The Pring bottom fisher. It's picking this out as being a bottom. That pullback that we saw after the run up from the election, it generated a buy signal in here, which really would have been pretty good. Well, now this is starting to wear off. But we're still above all the moving averages. We haven't even really come back and tested the short-term 20-period moving average, at least yet. The RSI, based on 14 periods, it's declining, but still above 50. So that's showing good longer-term momentum in the intermediate term. Also declining, but in this 50 area with the RSI 9, which is more short-term. And we've gone from positive back to neutral with the Elder's Impulse system for the S&P. And now we have three dots on top with the parabolic SAR. This is a primary indicator, and we're positive when the dots are underneath. We're negative when the dots are on top, and that switched to negative after Monday. And we're also still declining here with the bullish percent index. Even though we're above 50, so it's positive, the context is that this is declining. And we're also coming down with the NYSE bullish percent index and coming down, but still giving us a real high reading with the NASDAQ 100 bullish percent index. And I haven't shown this in a while. This is the Ichimoku cloud. A lot of folks really use these. And really, all this is just some moving averages and then shifted forward, which sometimes will act as support. That's not what I wanted to point out here, but the reason why this is in the support part of the video is because we often use this when we're hitting the cloud if we start to really pull back. What I wanted to bring this up for is that we're dropping below the blue line. Now, we're positive here because the blue line's above the red line, but the fact that we're coming under the blue line could be more short-term negative. And then there's another green line back here, which has been pretty strong, but it's been chopping around and saw a little bit of a decline on Thursday. Then this is longer term. We could be hitting the upper end of this trend channel, which is why the S&P is having a little bit of a problem breaking up above that. And we're kind of looking a little more dojious or more not really showing much of a trend here currently with the Heiken Ashi chart. When it's black the way it is now, that's negative, but we did have a positive candle that was drawn after Wednesday. And the Keiki chart, though, it's still positive. It's black and pointing up. We're still positive with the Renko chart, but we're still negative with the three-line break chart. Okay, then longer term, haven't shown this in a little bit. This is the 150 and 200 period moving average study, where we have been dropping down a little bit. Now, this is not turning negative. It won't turn negative until we see much more of a decline. But we have been seeing a little bit of weakness coming into the longer term, but we're still positive when you take it all together. And we're negative with the mid caps and the small caps in the short term. Surprise, surprise there, where all the other indexes are positive on the time frames. And then stocks are still positive across the board, but bonds are negative in the short and intermediate term. We switch back to positive with commodities after they had been negative across the board. And the dollar's been holding up fairly well lately. So we saw two areas that were up. Staples and communication. Now, communication, that's a growth area. We want that to go up, but it wasn't up all that much. Staples is more defensive, but then all the other sectors ended up being down, led by discretionary, which has been one of the better performing areas since last August. We want tech to do better, but it ended up being down. And financials are still taking a bit more of a hit than what we've been seeing recently. And I'll show you that chart later. So seeing some initial green or blue here with the Nasdaq getting above 898, 19.8 to 19.7, 19.9, bouncing all over. The euro, it went below 105, then I'm back above 105. Now it's back below 105. We have the Nasdaq. It did set an intraday high earlier in the day, but that didn't last all that long. This is encouraging with the tech sector setting a BPI cross above 70. That means some strength there. With the Nasdaq setting a 4-year high, but then it ended up dropping off at the end of the day too, down below 19.7. So we're seeing a decline, but a little bit more of a decline here when we compare it to the equal weight. The bar chart is the weighted version of the S&P, the one that we look at and see so much. The red line is the equal weight version, and it's been going down even as the S&P had been still going up, and that was a bit of a negative divergence there. Another warning sign that we were seeing. The Dow has been declining too, but it's still right at this pivot point now. So this support level is currently holding. But we continue to be negative with the Elder's Impulse system for the diamonds, which is the ETF for the Dow. The NASDAQ did come down a little bit, 0.2%, but still looking pretty good. It's one of the stronger looking areas currently. And we also declined, but we're virtually unchanged here with the NASDAQ 100. I guess we were down 0.68% here, but we're still above this pivot point, both with the NASDAQ and the NASDAQ 100. So these support levels are still holding for right now. We've gone from positive to neutral with the Elder's Impulse system for the Qs. Momentum for the NASDAQ 100 is still positive. Small caps, and I tried to point this out when it happened. We came down to this pivot point, and so far we're still above that. Even though we're looking a little more negative here with small caps, this support level continues to hold up. Are we going to be able to hang on to that and bounce up off of that? We haven't seen that yet, but we haven't broken below this pivot point at least yet either. And we're looking a little more negative with the other small cap index, the Russell 2000, where you can see we saw this really nice run up and then give back. Momentum is also negative, and we're dropping below 50 with the RSI. We're still negative with the Elder's Impulse system for the small caps. Also seeing this pivot point holding up for the mid caps as well. Is that going to matter? There's a lot of algorithms out there, computers that trade, they have all this stuff programmed into them. And when we hit one of these pivot points here and we're coming down, that could produce a lot of buy signals. Just like when we're going up and we hit one of these from the underside, that could produce a lot of sell signals. And we're still negative with the Elder's Impulse system for the mid caps, coming off of a recent all-time high with the Wilshire 5000, also a recent all-time high with the total US stock ETF. This is the financial sector, and I actually dropped this out of the video for a few days because we're looking pretty solid here, but we're seeing more of a downward trend than what we've been seeing in a while. We're still positive. We haven't even come back down to the 50-day moving average, at least yet. So we're just suspecting at this point there's still more profit taking going on. The FANG index just coming off of setting an all-time high on Wednesday, and it was down 0.5% on Thursday. That's the really big mega cap stocks. And we were watching this short-term trend line. We could be having some difficulty actually breaking above this for the FANG index. Apple was up 0.6%, looking pretty solid there. Amazon was down 0.5% after setting an all-time high. Meta down 0.3% after setting an all-time high. And Google was down 1.76% after setting an all-time high there. This is where the strength came from on Wednesday. And Microsoft was up 0.13%. Nvidia was down 1.41%, right back dealing with its 50-day moving average. And Tesla was down 1.57%. And these have been stronger areas of the market. Not a real surprise if folks are taking some profits here. But we saw nice up moves on Wednesday. We're seeing weakness on Thursday, and that's why the index ended up going down. And then Netflix was down 1.18% after setting a recent all-time high. And we're keeping an eye on semiconductors because this is a little bit kind of giving us some concern. We look at a ratio between semiconductors and the Dow. This is tech versus blue chip, the biggest, best quality stocks. The only problem is Nvidia has now been added to the Dow. So that's actually helping the Dow hold up a little bit better. But we've been a little bit concerned as this ratio has been coming down and we've been chopping around a little bit. It went up a little bit on Wednesday. It came down a little bit on Thursday. But we're just keeping an eye on this one. And then oil was down a third of a percent after getting back up to the 70 level. And then we look at world stocks and on the short-term correlation with US stocks here, and that relationship is fairly strong, and we're seeing an improvement here with the longer-term relationship. And then getting back to the semiconductors, this is the chart that's kind of giving a concern right now. When you look at just the sector chart itself, or this index, the SOX index, we're below both of the moving averages, and we've seen a death cross here. And I'm like, okay, this is not looking all that good. And then we look at another ratio between the semiconductors and the tech sector. Earlier in 2024, the semis were really outperforming, and that was really driving the market higher. Now it's been underperforming pretty much throughout the late summer, fall, and getting close to winter now. And this is a concern for the market when we see the semis underperforming. That's the negative side of things. But when you look at the SMH semiconductor ETF, we're still above the 200-day moving average here. Or if I go back to the sectors, we're below the 200-day moving average. So it depends on what you look at. This shows that support has been broken. This SMH chart shows that support is still holding. So we'll be watching both of these to see if we're able to bounce up off of this. We had a pretty good day on Wednesday, but then we were down 0.97% on Thursday. And this is that same chart, the SMH, and with a rainbow here, where we've been just going sideways ever since we were really running up nice in the summer months. We hit that top in July, and then we've just been kind of floundering. And this is when the mega caps were really underperforming. But the rest of the market was then kicking into gear and doing a better job, and that was helping things. We want this to do better if tech's going to be able to do better, and the mega caps are going to be able to do better. And then the dollar is in an uptrend here, and it ended up being up in Thursday's session. We were up with the 10-year yield. That could be pressuring stocks. We've actually seen a recent golden cross here with the 10-year yield, with the 50 crossing above the 200-day moving average. And we're going down with the 10-year based on price dropping below the 50-day moving average. And this is the 10 to the 3-month yield curve. We're right back at zero. They're even with each other right now. If we continue to go up, that will make them uninverted or going back to normal. If we fall back down, they'll still remain inverted. And then the growth to value ratio still holding up fairly well here. And this is one of the under the surface things that is still positive that we see with cues to the S&P. Discretionary to the S&P and large cap growth is outperforming large cap value. So the large caps, mid caps, and small caps still looking pretty good here. And this is under the surface that could bleed into things turning positive once we get prices going back in the right direction. And then the S&P to utilities ratio is going up. It's not that the S&P is really strong right now. It's that the utilities have been seeing some weakness. And so this just means the S&P is outperforming. All right, what's our outlook for Friday? We're still positive, believe it or not. We've had 3 out of 4 down days this week. And we do have in the bigger picture positive seasonality. But right now we're going through a period of negative seasonality. And we do see this weakness that I was trying to point out there throughout the different charts. We're going to get import-export prices in Friday's session. Not a real big impactful report. And then the crazy stuff going on in the world to see if the market does anything with that. So here's the finishing out of the economic calendar here. This is Wednesday and Thursday's session. I haven't updated it with what it actually came up with yet, and I'll be updating this for next week. But when we look at seasonality going back to 2002, we're neutral to negative with the Dow, S&P, and NASDAQ. And this is the negative seasonality that I've been talking about. As we got into this week, we saw the green dash line drifting lower, and this could actually go through into Monday. if we stick to what seasonally has happened before we see things show some signs of improvement, and then as we get through the month of December, things tend to turn a little bit better. But we don't know. There's no guarantee it's going to play out like this. We just see what has already happened in the past. Friday is one of the more positive days in 2023, and it's the most positive day in 2024 so far. This is a newer chart. Santa comes later in December. And as we get into the 16th or so of December, this is when we see the real robust action of positive seasonality from 1950 to 2023. And then the S&P has provided positive returns in the first year following U.S. elections. And these are months here. Don't think, 12 years out. Wow, look at that. This is just since Trump was elected, and they're calling it 2.0 here. And this is historically how things play out. The S&P 500, 1 year from the election date, going back to 1960. And things tend to be positive in the first year after a new president is elected, or in this case, reelected. Here's Tom Bowley's research. We're still battling through the negative part of his research before we switch back in, and this will be in Monday's session where things start to turn a little bit more positive. So the warning signs, we're concerned about our smart money indicators. They were showing some improvement after Wednesday. Now they're looking more negative with all three of them. And the advanced decline lines we're seeing some weakness. We're starting to see some of these indexes dropping below their moving averages. And the 5 and 10-day equity put call ratios are still going up, and that's more negative for the market. We're still negative with the NYSE McClellan oscillators and summation indexes, as well as for the S&P. And the bullish percent indexes are declining for the S&P and NYSE. We still have that non-confirmed Hindenburg-Ullman. The parabolic SAR is now negative. The Swenlin trading oscillator is negative, and the 20-period moving average study is also negative. And then the positive things are that the vortex, but we're seeing a little bit of weakness there. This is more encouraging. We're growth to value and discretionary to staples. Even with the declines that we've been seeing for most of this week, these ratios are still holding up quite well. And we're seeing some weakness in our oscillators. They're still positive, but they are starting to roll over. The copy curve is still positive, but not really showing a lot of strength currently. And we're watching the 50, 100, and 200 period moving average studies. If they drop below 50, that's going to turn this more intermediate. The 50 is intermediate term. The 100 is intermediate to long term, and then long term is the 200. That could turn all of these more negative. And we're still extreme with the bullish percent index for the NASDAQ 100. That's, again, some positive things to look at under the surface. The ease of movement, the money flow, and the ultimate oscillator. This is actually dropping a little bit below the midpoint, the ultimate oscillator, but the other two are still positive. The momentum for the NASDAQ 100 is still positive. In the financial sector, it's positive, but I showed that chart where we've been seeing more than just a couple of days of declines there. And then we have the Hindenburg-Ullman, which is still not giving us another spike. As I mentioned earlier, we have until December 19th to see another spike up on this chart. If we don't see that by the 19th, then this chart will go away and I'll stop having to talk about this. So our conclusion, in the bigger picture, we are still positive with a bigger picture look at positive seasonality, but we still see this weakness that's continuing to develop. In the short term, now we're back to saying we're pulling back here, and we do have short-term weak seasonality. In the intermediate term, we're also pulling back there, and this is where the weakness is developing. But we're still positive in the long term. Even though the 150 and 200-day moving averages are taking a bit of a hit, we're still looking pretty solid when we look at the long term. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.